Hi, everyone. Thank you for joining and welcome to today's webinar, How to Get a Private Student Loan. I'm Katie Flynn, Editor-in-Chief at Saving for College, and I'll be serving as moderator for today's event. Saving for College is the leading independent source of information on 529 plans, student loans, and the best ways to save and pay for college. The high cost of college continues to be an issue for many families. The cost of tuition, fees, room, and board at a four-year private college during the last school year tops $50,000. Students who went to a four-year public college paid over $20,000. Few families are able to pay the entire bill out of pocket. In fact, according to Sallie Mae's most recent How America Pays for College report, the typical family covered 20% of these costs with borrowed funds, including federal and private student loans. During today's webinar, our expert panelists will be answering your biggest questions about using private student loans. Mark Sir from Saving for College is also joining us, and he'll be sending out links to relevant content on our site that can help you further your research on student loans. And with that, I'd like to introduce Ed Gonzalez and Shannon Vasconcelos. Ed Gonzalez has over 25 years of experience in the higher education student finance industry. He's held financial aid positions as Assistant Director of Financial Aid at Drew University in New Jersey. He's been a Client Services Representative at the New Jersey Department of Higher Ed and a Business Development Manager at ELM Resources. For the past 18 years, Ed has worked for Sallie Mae in various sales and sales management positions and is currently Director, Assistant Region Head, managing relationships with colleges, universities, and high schools in the Northeast. Ed is an active member of various regional and national financial aid associations and is a frequent speaker and presenter on various planning and paying for college topics. Shannon Vasconcelos is Director of College Finance and Social Media at Bright Horizons College Coach, the nation's leading provider of education advising services to organizations and families. At Bright Horizons College Coach, Shannon delivers workshops and provides individual counseling on the college finance process. She helps parents and students understand the processes of saving for paying for college and education loan repayment, and helps maximize tax breaks, financial aid, and scholarship resources available to them in a family-focused and ethical way. Shannon has been featured as a college finance expert in numerous media outlets, including the Today Show and Good Morning America. Prior to joining Bright Horizons, she worked in student financial assistance at Boston University and Tufts University. We're very excited to have you both here today. So, but just a few quick housekeeping notes before we get started. As you all know, we collected questions during the registration process, and we're going to try to address some of those as we go along. And you can also type your questions as we go into the Q&A box. But please remember to use the Q&A box and not the chat feature so that we just make sure that we see your question. It is possible that we won't have time to answer every question. So if we miss yours, please visit our forum at forum.savingforcollege.com and you can ask your question there. We are recording this event and you'll receive a link to the recording and a follow-up email. So let's go ahead and get started. Ed and Shannon, I'm so happy to have you here today. Is there anything you'd like to say before we start taking questions?
Well, Katie, I just want to thank you for the invite, and I look forward to the next hour sharing as much as we can share with the group. Shannon's expertise is very valuable, so I'm sure I'll learn a little bit from her as well. So thanks for having me.
Ditto, Ed, and thanks, Katie. And I'm just welcome everybody. I'm glad you're here. I think the biggest thing about when you're considering borrowing student loans is to be an informed consumer. And so you're all here to learn more. So I think that's wonderful. I'm hoping we can pass on some helpful pieces of information over the next hour.
Okay, that's great. Let's go ahead and get started. We'll start with the list of topics that we're going to cover today. So when you see a particular topic on the screen, you can go ahead and type your question related to that topic into the Q&A box. So let's start with how much should I borrow? We did have one question submitted asking how much should you borrow? This question specifically asked, what mix of loan amounts do you recommend to be borrowed by students and their parents?
Katie, a good starting point for an answer there is we have at Sallie Mae, we call it 1-2-3 approach to paying for college. The one being, maximize free money, whether it's money from savings or scholarships certainly we recommend looking for scholarships as early and often as possible. The second is to explore federal options, so completing the FAFSA application to access any grants, both federal and state, that may be available. That is free money as well. You should certainly explore the child student loan eligibility as a result of filing the FAFSA. And then that third component would be what we're going to speak about today, is exploring some private loan options. So how much to borrow would really, depend on following that approach and really only borrowing what your needs are for either the semester or for the entire academic year after exhausting the previous 2 points that I mentioned.
And I guess I would just add, to follow up on what I just said at the beginning in terms of being an informed consumer, I don't think that there's a magic number of this amount is appropriate to borrow, this amount is not. I think it's going to differ for every family, as well as that kind of split between who's doing the borrowing, how much should the student do, how much should the parent do. But again, just really you want to be an informed consumer. And I think what to think about in terms of figuring out what's an appropriate amount for you to borrow, you want to make sure you understand what your monthly payments are going to look like after graduation. I know Saving for College has a great loan repayment calculator that you can use. It's very easy to just sign on the dotted line. Sure, I'll borrow $10,000, $20,000, $50,000 without really understanding what that equates to when you actually enter repayment. So you really want to understand what you're going to be looking at in terms of repayment after graduation. In terms of the student, I think you want to try to have an idea of what your salary after graduation will be. This is much easier said than done, because most students don't know what they're going to be doing after graduation. If you think you're probably going to change your mind at some point over the course of college. So I think my recommendation there would be you might want to be a little bit conservative in terms of how much that you borrow, because you don't want to get in over your head. The federal direct student loans that just about every student can borrow, those have annual caps at $5,500 to $7,500 per year. So over the 4 years, if you do the math, it ends up being $27,000 total that the students can borrow in their name alone. I think that that's a reasonable amount of debt for a student to take on and be able to pay back with their first job out of school. When you get beyond that, that's when you certainly have to think harder about, will your future salary be able to finance the repayment on these loans? And beyond that, I'm sure we'll get into it later as well, in terms of thinking of the balance of student and parent loans. Most students cannot be approved for loan money beyond that $27,000 in direct Stafford loans without a cosigner. So usually your parents are going to have to step in at the very least as a cosigner on a private loan, if not the primary borrower on the loan.
Good point.
Yeah, that's a good point. And, I know you both mentioned the federal student loans, and we did have a question submitted with registrations about the benefits and disadvantages to private versus public. So maybe you guys can touch on that quickly.
So there are many, and looking at that, the comparison, many people will fall into different areas and different details of those comparisons. But for the most part, private loans generally do not have a fee, an origination fee or a disbursement fee, and federal loans do have a fee, both at the parent level and at the student level. There are different interest rate buckets as well, which we'll get into that a little bit with more detail as we proceed. But the fee structure is one of the things that is most commonly discussed. Another item that's commonly discussed is bringing a cosigner into the equation, or having the ability to bring a cosigner into the equation to help you secure either the loan itself, approval versus not getting approved, or securing a lower rate because you bring in a creditworthy cosigner on the private side. On the federal side, the PLUS loan as an example, the parent is the borrower. That parent takes on the debt. The parent takes on the responsibility all through repayment. And, in case you're wondering, it does show on the parent's credit report, and it will stay there throughout the life of the loan. On the private side, most of the lenders are Sallie Mae loan, and most of the lenders in the industry, the student is the primary borrower, which gives that flexibility in terms of, I'll help you get the loan, and then at some point in time, I can potentially get removed through a process called Cosigner Release, which again, we'll discuss in a little bit more detail as we proceed. But those are the three main points that we discuss most often with families when they're comparing federal versus private.
Okay.
Yeah, I guess. Sorry, I was going to say that the only things I would add, I totally agree with everything Ed said there. Another thing perhaps to think about is, well, I guess definitely to think about is, can I be approved for this loan? That is one different. The credit review process is different for the federal and private loans. First of all, for the student loans, the direct student loans, the $27,000 that we mentioned earlier, those are automatic as long as you're, U.S. citizen or permanent resident, that sort of thing. There is no credit review, and those interest rates tend to be lower. So most students will take advantage of those federal student loans first, but then when it comes to the federal parent plus loan, which is usually what's being compared to a private loan, the credit review for the plus loan is often a little bit easier. They just look for kind of negatives in your credit history in the past 5 years. It's a less extensive review than often is done on a private loan. Definitely, as Ed said, compare the cost of the loan, and that's the biggest part of that is the interest rate. The plus loan rate for next year is about 6%. What is it? 6.228 for this upcoming school year. You may be able to do better or worse than that on a private loan, whereas the federal loan rate is kind of standardized. Everybody gets that. With a private loan, it's going to depend on your particular credit history and that credit review. If you have good credit, you may be able to do much better than that. If you have poor credit, you may do worse than that. So you have to sometimes kind of shop around a little bit there. The fees, of course, as well are a big difference. There's that 4% fee with the plus loan that usually does not exist with private loans, but you definitely want to check. Every private loan is a little bit different, so you want to check on that. And the repayment terms can also vary. The plus loan does have some flexible repayment options in terms of there's income-based repayment plans, extended repayment plans, graduated repayment plans. There's different options. As you're exploring private loans, you want to check what kind of options you have that the lender is offering you in terms of repayment. Are there forgiveness possibilities that exist if you work in public service currently on federal loans, but not on private loans? Are there protections, like the federal loans are canceled in the event of death or permanent disability? Some private loans offer that same protection or similar protection, some do not. So that's certainly something you want to look into.
Okay. All right, well, let's move on to the next question, the next topic, which is what can I pay for with student loans? So Shannon and Ed, why don't we start by just kind of giving a brief overview of what student loans can be used for, and if there's any certain, qualified expenses people need to pay attention to.
Yeah, so student loans can be used to cover anything within what they call the cost of attendance of a university. Every college sets this cost of attendance budget, which includes, and I apologize, of course, they decided to do yard work right outside my window just now. I'm hoping you can hear me okay and you're not picking up on the landscaping. But anything within the cost of attendance, which includes tuition and fees, also includes room and board, as long as you're at least a half-time student, includes books, supplies, other kinds of, the school sets a small budget for kind of personal expenses, transportation, things like that. So student loans can theoretically cover all of that. What happens with the student loan process is usually your student loan proceeds are sent to the school first. They take whatever they need to cover your actual bill. And then they issue, if you borrowed more than that, so borrowed to cover books or off-campus living expenses, the school will generally issue you a refund or issue the student a refund to use for those kind of off-campus non-direct billed expenses. But you can cover most everything that you would sort of normally think of in terms of college costs.
Yeah, and some programs will even allow you to borrow for equipment. You know, if there's equipment requirements for the programs, especially some of those, let's say, less than half-time programs that you did mention, the difference between, you know, up to half-time study and less than half-time study. So federal aid is not available for less than half-time study. Private loans are available for less than half-time study. So again, there are some differences between just a traditional versus a non-traditional route and what is available to you. So again, check with your lender to see if they offer less than half-time study, if that's your situation. But again, overall, you know, whatever expense can be tied back to the program, to the transportation, to the miscellaneous costs can certainly be included.
Okay, because we did have a few specific questions. Someone asked about full-time, for a full-time community college student, could they use their student loans to pay for housing?
Yes.
I would say, yeah. If they include it in the cost of attendance, absolutely.
Okay, and what about fraternity or sorority fees? Would that be something?
I would generally say no to that in terms of at least the federal loans. It usually has to be a required fee. You're not required to join a fraternity or a sorority. So I think the general answer on that would be no. I don't know, Ed, based on your private loan experience, if you have a different answer.
I must say that's the first time that I actually hear that being asked. We really never addressed it, but if it happens through the normal set of charges that the school bills and or includes in the cost of attendance as a miscellaneous expense, then I would say yes.
Okay, so sometimes they check with your lender is probably the best answer.
Yeah.
Okay, so moving on, speaking of lenders, we're going to go into how do I choose a lender? So I guess you can both kind of give your statements on that, and then we can go into the questions.
Yeah, this is a common question all the way down from elementary school on up, right? As people start to prepare, and at the high school, college level, the number one answer should be, please check with your intended school. So if you have a list of 3 or 4 schools that you're intending on applying to, check out their website to see which lenders they recommend or which lenders the families at that school have borrowed from in the past. So those are 2 different types of lender lists, as we call them in the industry. The school could have a preferred list in which they actually handpick through their own criteria the lenders that they want to do business with, whether they are, you know, the most common used on campus, whether their rates are the best, whether their technology and dispersing platforms are suitable for the school's system, or a historical list of lenders that students have used from that particular school, either this past year or in the past few years. So all that information would be available on the school's website, and that really is the first point that you should look to in terms of knowing who's out there and who's doing, you know, business on campus with that particular university.
Yeah, I would agree with that, that the school's lender list is a wonderful starting place. You could also check with any banks or credit unions that you happen to bank with, see if they offer any kind of student loan, and look at how that compares to lenders on the school's preferred lender list. And I think Mark has thrown in the chat that Saving for College also has a great lender list showing kind of a chart with the terms of various lenders. So that's another great starting place. And in terms of how to choose between them, you know, you're looking at some of the things I think that Ed and I have already talked about. What's the interest rate? Are there any fees? What are the repayment terms? Is a cosigner release option available that I think Ed spoke about? Those are all things. Who is the actual lender, the student or the parent? Those are all things you're going to want to compare among any private student loans that you're considering.
Okay, and I know you both touched on interest rates. And we did have a question. How do you compare student loans? I mean, some have variable rates and some have fixed rates. So how would you go about comparing those different types of interest rates?
What we see in the industry is most consumers generally, first of all, most consumers think that they have, better credit than they actually have, right? And that's me included. And Shannon and Katie, I don't know, you can speak for yourselves, but for the most part, most consumers, tend to think that they'll be more comfortable with a fixed rate. However, the process does give you an option. Some lenders offer both variable and fixed rates and let the borrower decide. Our loans at Sallie Mae do that. We offer every approved application both a variable rate and a fixed rate, and we let them decide. There is a wide stretch in the margin between the two. Again, consumers that would generally feel more comfortable with the fixed rate once they see the slightly lower variable rate being offered, could considerably save some money during their repayment term. So it could be a change of decision there based on the rate and based on their credit worthiness, which this all comes back to. So, the actual rates that are offered are based on the credit worthiness of the application. So it really is important to seek out and maybe compare and contrast. So apply to more than one. You do have the ability to do so within a 45-day window without a negative impact on your credit report. And I know that we're going to address that a little bit later, but again, take advantage of all of these nuances that the system allows you to take advantage of in order to secure that best rate. But again, for the most part, the lending community offers both, and they're specific to the lender of your choice. You would have to do a little bit of research there, whether it's on the lender's website or just ask the school some questions.
Yeah, and I would just say, a basic question in my mind when making that decision is, how long do you think it's going to take you to pay off this loan? To probably actually take a step back in case anybody doesn't know the difference between variable and fixed rate. A fixed rate is locked in generally for the life of the loan. So you know what you're going to get for the life of the loan. A variable rate changes often quarterly, depends on the lender. So you don't know really what you're going to end up paying in the end. But they generally start off lower. You just don't know what's going to happen with interest rates over the course of repayment, whether that be, 5 years, 10 years, 15 years, whatever it is. So, I think, again, a big question that you should ask yourself is, how long do you think it's going to take me to pay off this loan? If you think you can pay off the loan in a few years, maybe you want to take the risk on a variable rate, thinking, interest rates probably won't change too outrageously over the next few years. But if you think it's going to take you 20 years to pay off the loan, that you're taking on a much bigger risk there with a variable rate loan. I don't think any of us have any idea what's going to happen with interest rates over, a 20-year time period. So it's just a riskier proposition. Maybe if you have a longer time horizon, you would like the safety, kind of security of a fixed rate loan. But of course, it's definitely an individual decision, but those are some of the things you might want to think about.
Right. And I would just add one more thing there. In addition to trying to figure out how long you're going to be in repayment, another way to save some money is to be able to make payments while you're in school, even though they may not be required. A lot of people tend to save money that way. So they kind of cut down on the total out-of-pocket expense over the life of the loan. So that's where we see a lot of gravitational pull towards those lower variable rates, because people do make the decision to either pay down the interest while they're in school when they're not required to, or just start payment of principal and interest while they're in school, again, even if they're not required to do so.
Okay. And I know you mentioned, I think you both mentioned that the colleges themselves do provide a list of lenders and probably some information about interest rates and terms and other things that they offer. We had a live question from someone that's asking if the colleges receive incentives or rebates from the private lenders.
No, that's a big no. Now that I understand. Again,
That would
again,
be illegal.
yeah, that would be illegal. That would be an inducement. That would be.
A million years ago,
No good.
when Ed and I maybe started in this industry, there was some of that. The government put the kibosh on that many years ago. So
Yeah,
there's no inducements for being on a preferred lender list.
no inducements at all whatsoever. That's why, yeah, my comment earlier was, they would recommend, legitimate lenders that work well with their families and have shown to work well with their families, with the school's process, et cetera. So that's a big no.
Okay, so the colleges that would be your most trustworthy source to start with.
To begin with, yes.
Okay. All right, and looks like we're ready to go on to the next question, and that has to do with credit scores. I know you guys both mentioned this already. If you want to start out by just giving a brief explanation of how the credit scores work.
Sure. Well, credit score, what do I need? It varies by lender, I will say that. So you can check with each lender individually. We have lenders that go down in score down to the mid to low 600, so 640 on up as an example. But there are also lenders that don't look at anybody's credit score if they're under 700. So you have to do some research there on your own. But I will say that the credit score is not necessarily the only factor. You have to keep in mind that they're going to do an overall credit review of your score, the components that are in your credit file, which is obviously is your past history. Some lenders may use a debt to income ratio. Others may have some type of a salary and income requirement. So although the models may appear to be similar across the industry, they could be very, very different when it comes to each individual lender's proprietary model. So don't be either overly excited or overly disappointed by where your credit score is based on how much you have to borrow and what the interest rate environment is looking like. So there's a lot of resources available there as well. At sallievay.com, you could find some more information about FICO scores. We do have a partnership with FICO, so we filter a lot of information that way. Go out to the FICO, the 3 credit reporting bureaus, and to FICO themselves for some more information on credit scores and what is generally a good credit score, or what is perceived to be a good credit score. But again, we could talk a little bit more in detail a little bit later on through the process here regarding that background information. Shannon, do you have anything that you would like to add there?
I guess just to make the point, I think I mentioned it earlier, that one of the differences between the federal plus loan and a private education loan is that the federal plus loan does not look at your credit score at all. That's one of the big differences in the credit review between the different types of loans. The plus loan will look for any significant negatives in your credit history in the past 5 years, and that's where they cut it off. They're not looking at your credit score. Now, I would say there's generally a correlation there. If you have, a very low credit score, that likely means you've had some issues probably in the past 5 years, and that could be a problem with the plus loan as well. But it is a difference in the credit review. The other thing just to throw out there is, in relation to the credit score, is with the private loan, it's often going, or at least as you can follow up on this, Ed, be part of the credit review that determines what interest rate that you get, as opposed to the plus loan that's that standard 6 point something for everyone. With private loans, you will see as you start kind of shopping around that most banks will advertise a range of rates, and where your credit, if you have very good credit, very high score, other good things, you'll get the low end of the interest rates. Whereas if you have a low credit score, that's when you're going to get a higher interest rate.
Yeah, that's general rule of thumb. Again, but most, every lender will ask for different different things on their application during the application process, and also have different models where they would, rate one factor higher or lower than another.
Now, are the lenders mainly looking at the parent's credit score? We have a couple of people asking how is the student's credit score taken into consideration, and how would you know a student's credit score if they don't really have credit yet?
Okay, so and Shannon, I'll bounce off the federal information to you. The answer that I'll give you is twofold. So first, the student. If the student has, on the private side, most private lenders have students be the primary borrower. And obviously, if they're a traditional college student, 18, 19 years old, they have little to no credit, or if they have little to no credit, they'll be asked for a cosigner. The information can be found either on the credit bureau's sites to find out what the student's credit report is once you begin the process, just so you know a baseline number. So every consumer is really entitled to accessing their credit report for free on a 12-month basis from each one of the 3 credit bureaus. So that would be a good starting point for the student. The second half of that answer, now if I remember the question correctly, is that the private loans would take a look at the cosigner's information, in this case, much more heavier and much more thoroughly than the student borrower who has little to none. The Sallie Mae process uses a combined look. So we look at the application, the overall strength of the application. We don't necessarily separate the student from the cosigner, which is why we kind of encourage cosigners to come into the process to help the student, because we look at the total strength of the application. So having 2 credit scores and 2 credit files, even if one is much, much, much better than the other, would help out the process overall. But again, it varies by lender.
And I would just say, in regard to the federal process, we talked about the direct subsidized, unsubsidized student loans that are automatic. There's no credit review at all. And for the student there, for a parent to borrow a PLUS loan, it is solely based on the parent's credit history. Again, not score with a PLUS loan, but their recent credit history. That is entirely based on the parent. Again, no credit review for the student at all. The only time a student credit review would come into the picture on the federal side is for a graduate PLUS loan. So if you are a graduate student, you can borrow a certain amount of the direct unsubsidized loan. But then if you need more than that, you can borrow what they call a graduate PLUS loan. We've been talking largely about parent PLUS loans, assuming we're talking largely to parents trying to finance their kids' undergraduate education. But graduate students can borrow their own PLUS loan on behalf of themselves. And that would be the only time on the federal side that a student credit history would come into play. And again, it's not a credit score, it's just looking at the past 5 years credit history. And for a graduate PLUS loan, it is a-okay if the student has 0 credit history. You can still be approved for a graduate PLUS loan as long as you have no big negatives in your recent credit history. You can get a graduate PLUS loan. Whereas having a limited history with a private loan, correct me if I'm wrong, Ed, you likely will need a cosigner on the private loan side as a graduate student with limited credit history.
Yeah. Again, it will all depend on the individual. Limited, thin credit files usually require a cosigner in most cases. But again, at that graduate level, there are other nuances to FICO scores and credit history as well. There may be some, employment that can help a student, bypass some of those checks at some lenders. So it really is, lender specific when we're getting into the weeds in that one.
Okay, and then a follow-up to this question, we have what to do if you get denied. I know cosigner is an option, and we're going to get into that in the next slide, but is there anything else specific we need to know about students or parents who get denied for a student loan?
Shannon, I'll let you take that one first.
Yeah, so the biggest thing I would say is to add a cosigner. On the federal side of things, if a parent is denied a PLUS loan, there are a few options. You can appeal a credit decision, a PLUS loan credit decision. You can reapply with what they call an endorser, essentially the same thing as what they call a cosigner on the private side. They call it an endorser on the federal loan side. Or if the parent gets denied a PLUS loan, they actually allow the student to borrow a little bit extra, $4,000 or $5,000, depending on your year in school, in the unsubsidized direct loan, in the student loan, if a parent is denied a PLUS loan. So those are the options on the federal side. I assume, Ed, on the private side, the biggest step to take would be adding a cosigner.
Yeah, definitely. That's the point in the process, at least with our process, that you would be asked to bring in a cosigner. The cosigner does not necessarily have to be a parent, as on the federal side, the PLUS process. So it could be any creditworthy individual who is willing to help you gain access to the funding. And since we have a cosigner release process, and that is detailed during the application process, it really does help those situations where the student would have gotten denied, or even if there is a denial with a cosigner, you can find another cosigner, because you always have that in your back pocket, that the cosigner can get released from liability once you're in repayment at some point in time. And I guess now's a good time to discuss some of that briefly. So many lenders do have a cosigner release process whereby that cosigner can get removed from liability from the loan once at some point during repayment. Our process begins at the 12th month of on-time payment when they're in repayment. So after graduation, after going through the grace period, 12 months of on-time payments, the borrower can ask for that cosigner to get released from liability. Other lenders, and at that point, we'll do another credit check on the borrower, only just to see if he or she can take on the additional responsibility. And if at that point it gets approved, then we can thank the cosigner for their assistance and release them from liability. So with our process, the first time that's available is at the 12th month of on-time payments after graduation, once you're in repayment. We have a caveat that says that, again, in some cases, you can request that prior to the 12th month, assuming that you're going to make the equivalent of a 12-month payment at some point in time during that period. Other lenders, again, similar processes, longer thresholds. Some have 24, some have 36, some even have 48. There are some that just, don't have them at all. So it really is specific to lenders on the private side.
And just to put kind of an exclamation point on what you said, Ed, the student has to be able to pass their credit review at that point to be able, it's not automatic that every cosigner can be released. The student has to have, a sufficient, credit history, income, that kind of thing.
That's correct. Our policy states that the student basically has to have enough credit worthiness to be able to get the loan as if they were applying for a brand new loan. So, whatever the FICO score requirement is, whatever the credit file requirements are that we look at, once they are at that point, that's when we can remove the cosigner. And, many students do need to apply maybe more than once. Our policy just states that after 12 months of on-time payments is the first time that you can ask for the cosigner release. If you don't get approved that time, you can come back at any point in time and ask for cosigner release at whenever it is that you feel that you straightened out whatever situation prevented you from getting the cosigner removed at that point. So you don't have to wait another 12 months of on-time payments. You can do it 60 days later if you feel that you've corrected whatever needed to be addressed.
That is.
Okay. we do have some cosigner specific questions. And I mean, I think the biggest one I've seen most frequently from the audience is about, is it common to get a private student loan without a cosigner? I mean, does that ever happen, or is it mainly most students need to have that cosigner?
Well, most traditional, let's say, freshmen and sophomores need to have that cosigner. Here's something that's interesting though in the process. So if the lender is offering a private loan in which the borrower is the student, so that student that gets approved with a cosigner their first and or second year, now they've built up 2 years of credit report. If they've made interest payments or if they've made some principal payments, without being required to do so, they've cut down the debt on that loan. They've made some payments on a regular basis, so they have some credit history. So where I'm going with this is that as juniors and seniors, they may not need a cosigner any longer. And that's just with our private loan. That does not speak to anything that they've done on their other credit cards or with their traditional consumer credit. So if they're behaving properly with ours, they're probably behaving properly with some of those other ones. So they're in a much better credit scenario as juniors and seniors than they were as freshmen. So that is something that is very common.
Okay. And then a couple of questions from people who might be considering co-signing a loan. I know, Ed, that you did mention at the beginning that if you co-sign a loan, it is going to show up on your FICO score. So is there anything else credit related that potential co-signers should be aware of?
Well, it's important for all consumers to understand that, co-signing anything, whether it's, a private loan or a car loan or anything else, is you're agreeing to take on the debt in the event that the primary borrower fails to pay or cannot pay. So yes, it's on your credit report, which is why cosigner release for the private loans is pretty important, right? Because those cosigners could potentially want to cosign for other students in their household or other friends or relatives. But it's a shared scenario where you're agreeing to share the debt. So it does reflect on your credit report all the way until you get released. And the other component of the question, I think I just blanked out on.
Yeah, just things to be aware of, I guess, for potential co-signers. I know someone else was concerned because they had a Chapter 13 bankruptcy on their record, and how would something like that affect the co-signer application? And is there a time limit to where the bankruptcy might no longer be relevant?
I would say to check with your lender. That would really depend on the lender's policy.
Okay.
Yeah, and that's in contrast again to the plus loan. If the potential co-signer here is the parent and are thinking of borrowing the plus loan, a bankruptcy greater than 5 years old would not prevent you from borrowing a plus loan. But if it's within 5 years, it would.
Okay. Okay, and that's a perfect segue into the next section. So we're going to cover the differences between private parent loans and federal plus loans. And I mean, I guess on that note, it seems like we do have a few graduate students on the call as well. So maybe we can also touch on, for a graduate student, what's the difference between getting a private loan or getting a graduate plus loan?
So Shannon, I'll leave the rest of it to you now, but the private parent loan, it's important for people to understand the difference between a regular private loan and a private parent loan. So when we see that private parent loan is being discussed, we are referring to those instances in which a parent or another individual who is not the student. So this is now someone else wants to take on the responsibility of maybe gifting the education to the student, or for other scenarios, maybe just taking on all of the debt during all of the repayment term for other reasons. So the private parent loan is available to parents of students or non-parents of the student who are creditworthy and are willing to take on the debt. There is generally a cosigner process available. Again, it would depend on the lender. We at Sallie Mae, we do have a cosigner process available for those private parent loans. So now you're talking about a parent with another maybe non-parent cosigner getting a loan on behalf of this student. So that's obviously very different than our traditional route where it's, you know, one of those two, the parent or the cosigner, just co-signing for the student. So in all cases, the private parent loan, the student is not the borrower.
Interesting. Yeah, and I think we've touched on most of the differences already. There's a different credit review, often more extensive with private loans. Difference in interest rates, again, kind of standardized. Rates are reset every year with the PLUS loan, but for this upcoming year, it's about 6% interest rate, 4% origination fee, whereas with a private loan, those rates and fees can vary, very often zero origination fee, but not always. So that's something to look at. The interest rate will be based on your credit review with a private loan. Different repayment options with the federal loans. There is a standard 10-year repayment plan is the standard, but there are extended payment plans. There are income-based repayment plans. With a private parent loan, that's going to vary based on the lender. Lenders often offer various repayment plans. Sometimes if you agree to pay the loan off quicker, they'll give you a lower interest rate. So that's something to look at. And again, any protections that there might be. PLUS loan has kind of guaranteed deferment options, public service loan forgiveness possibilities, cancellation in the event of death or disability. Those kinds of things, those protections can vary by lender. They're not, with the federal loans, they're guaranteed. Every lender gets to offer their own protections, whatever they want to offer. So that's something that you would have to take a look at as you're shopping around for a private parent loan or private student loan. See if those protections are important to you, what the different lenders offer. And sometimes there can be, maybe Ed, you can address this a little bit, whereas the PLUS or federal loan protections are sort of spelled out. Sometimes I think it involves more kind of working one-on-one with the lender in terms of special circumstances that you might have.
Yeah, so for those repayment protections that don't mirror the federal process, you know, it varies by lender, but most lenders are willing to work with borrowers who are either struggling during repayment. You know, some will lower the minimum requirement for repayment for a certain number of months until borrowers get back on their feet. There are also forbearance opportunities in which the borrowers could go a certain number of months without being required to make a payment. You know, sometimes as long as they're addressing the interest that accumulates, that might be fine for some lenders. So there's not one blanket policy for these protections during repayment, you know, during hardships, as there are in the federal world. But many lenders do have pretty reasonable and flexible policies for hardship and for anyone who is struggling to make that minimum payment.
Okay. Just checking to see what questions are coming in. So someone is asking about loans that are available for their kids when they still have loans. And I don't really know the specifics. I'm thinking that might have something to do with, would a parent's existing loans affect the student getting a new loan?
In terms of a private loan, if that parent was wanting to co-sign for the borrower, nothing, the answer to the question is no, but the next step there is to inform that the amount of that loan debt outstanding shows up on that parent's credit report, just like any other outstanding debt. So, your Capital One credit card and your federal student loan that you borrowed 10 years ago when you were a student, they're both showing on your credit report. There, the message is that as long as you've paid on time for a substantial period of time, you should not be, hit any harder or, denied just on that reason, just because you still have an outstanding loan.
Okay.
And it certainly doesn't affect the student's federal student
Correct.
loans.
That's
They can
correct.
borrow those again, as long as they're US citizen, permanent resident, they haven't defaulted on a loan
Right.
themselves in the past, the students can get their guaranteed federal student loans, regardless of what's going on in the parent's credit.
Okay. Okay. Anything else for graduate students in the Grad Plus loans that borrowers should be aware of?
Again, I think the biggest difference is the co-signer requirement. Again, for graduate students that don't have a lot of credit history, Grad Plus loan is going to be easier to get because it doesn't require a credit history. The only requirement is you don't have negatives in your credit in the past 5 years. So for those graduate students who are maybe coming right out of undergrad that don't have a lot of credit history, sometimes the Graduate Plus loan is easier to get. But for maybe older graduate students who have a job, an income, and an established credit history, that may not be a significant difference for them. And that's when you're likely looking more about comparing interest rates and fees and repayment options, those kinds of things.
Okay.
Yeah, I'll just comment on the total cost of the loan. So with graduate programs generally being more expensive than undergraduate programs, they're looking to borrow, larger sums of money each of the years that they're in the program, whether it's a 2-year program, a 3-year program, and so on. So, the fee that's associated with the federal Grad Plus loan program will be a higher chunk of the total balance. So that, that slightly over 4%, 4.22, whatever it is, based on $20,000 is X, based on $50,000 is X plus that amount, right? So that would be something to compare and contrast, and just know that, you're going to add to that balance by having that fee associated with that loan, as opposed to in the private world with generally no fees. So that's the only thing I wanted to add there.
Yeah, totally agree. Oh, and I should probably just throw it out there for the graduate students on the line. I mentioned undergrads can only borrow between $5,500 and $7,500 per year in the direct student loan program. For graduate students, it's a higher number. It's more like $20,000 per year in most graduate programs. Health profession students like medical, dental, veterinary students can borrow more like $40,000 a year from the direct unsubsidized loan before you have to think about the potential for a Grad Plus or a private education loan. So just to throw that, those guaranteed loan programs, you're eligible for more money as a graduate student. But yeah, I totally agree with you, Ed, that 4% origination fee on the Plus loan, it's 4% of $1,000 or 4% of $80,000. That makes
Correct.
a difference.
That's correct.
Depending on how much you're going to borrow. Yeah.
Exactly. Yeah. Something to keep in mind.
Yeah, definitely. Okay, looks like we have time to cover our last topic, how to apply for a private student loan. So we do have some questions, but I'll leave it up to you, Shannon and Ed, to start the conversation about how to apply.
So application process is pretty simple, painless, we like to say. Online applications are available. Pretty much every lender provides their application process online. Ours, you could go to salliemae.com to start that process. Most lenders will allow either the student or the prospective cosigner to begin the application. That's what our process looks like. There's very minimal information that's required from the student, borrower, demographic information, social security number, date of birth, etc. We actually recently removed the income question from the students portion to allow them to get through that process a little bit quicker. On the cosigner side, again, there's some demographic information obviously that we ask for. We do ask for some other information such as their income, their employment, their history, their home, if they own or rent, very similar to credit applications. Our process online is pretty quick. We've cut it down to about a 7-minute average process from student point of entry to both student and or cosigner completion. Once that's done, and that 7 minutes does include a response for those that can be automatically responded to with an approval. After that, there's a disclosure period in which the student and or cosigner would need to sign off. They do have 2 more steps where they can change their mind, write a refusal. So every lender is similar on the back end with the disclosures, but to get through the application and to get an answer with our newly minted process by taking out a few of the questions that we were asking students to complete, we cut it down to about 7 minutes.
Awesome. I think the only thing I would add just in terms of the timeline, as Ed just mentioned, this can all happen very quickly. Thinking about, I often, I'm talking to students and parents about, paying their bill and when should I apply for a private loan to make sure that it's on time to pay the bill. I generally recommend leaving yourself a few weeks. So for those folks who have a bill due in, early August, I'd be starting now if you haven't done so already to lock in that private loan. Very often it doesn't take that long. It can be really, as Ed said, fairly instant credit approval. Once the lender approves your application, it then is sent to the college's financial aid office for them to put their stamp of approval on it. They call it certify the loan, just they're letting Sally Mae or whatever other lender know that, yes, you are, an enrolled student here, and this amount that you've been approved for is within our cost of attendance. You're eligible for this money. So it does have to go to the school's financial aid office usually as well. Again, this often is all completed within a few days, just in case anything goes awry along the way. Maybe you have to provide income documentation, something like that comes up. Give yourself a few weeks just to be sure, but it often happens very quickly.
Okay. And then as far as applying, we have a question from Mary. Can you go over the advantages and disadvantages of applying for a multi-year loan versus a one-year loan?
So there are both. There are advantages, disadvantages. So most lenders have what we have at Sally Mae. So with our process, you do have to apply every year, which coincides with the school's process and with the FAFSA process, et cetera. So what you want to be able to do in general is you want to be able to know that your funding is not going to dry out, so to speak, right? So generally, we have about a 93% multi-year approval rate, which means that if you come into the process as a freshman with a cosigner and you come back as a sophomore with that same cosigner, you have a 93% likelihood of getting the loan, same as you did the first year. What could change? Your interest rate could be lower, right? Because you and or your cosigner could have improved their credit situation. You could decide, to bring in a different, better cosigner if you like. So there's a lot of advantages to needing to apply every year. A disadvantage of a multi or of one loan to cover all 4 years is exactly that. So, this determination is being made now and may not consider any improvements in the process down the road. So you may be stuck and still bound by whatever your situation looked like, 2-3 years ago when you initially applied, even though you may have improved your situation at that point. So, which is why we like to, remain consistent with the federal formula and with the school's process by asking you to apply every year, and you're going to apply for, you might apply for different amounts every year, right? Because you may not need the same amount every year, as we mentioned in the opening of the session. You know, it's contingent upon some of these other things that you have available to you in terms of resources.
And just for clarity, I would say, if someone out there, I applied for a loan, I don't know what I did. Did I apply for 1 year or did I apply for a multi-year? The normal process is 1 year at a time. It would be unusual to apply for a multi-year loan. With most of the student loans out there, you're applying 1 year at a time.
Okay, well, it looks like we're coming up at the end of the hour here. So I just wanted to say thank you again, Ed and Shannon. You provided so much expertise and we're so helpful, and so happy you can join us. And thank you so much for everyone who attended. As a follow-up, if you're doing some research on private student loans, we do have a couple pages on savingforcollege.com with our rankings and reviews. You can visit those. I'll have them up here on the slide, and I think Mark will also send those out in the chat. And again, you'll receive a follow-up email with the recording, and we'd love to hear your feedback. So thanks, everyone.
Thank you for having us.